How's it going, everyone? Welcome to the sweep. I'm just going to give you guys a moment to read over the disclosure, and we'll go ahead and get started. Appreciate you guys being with us. Of course, as always, if you have questions, feel free to chat those questions in. Even if you're watching in replay, by the way, guys, you can chat those questions in, and when we see them, we'll make sure that we comment on that chat later on, or put it in the comments later on as well. So don't feel like if you chat because you're not watching it live, you're watching the replay, that you're not going to get your questions answered. We'll definitely reach out and get your questions answered for you. All right, let's go ahead and get going. So, as always, like, share, and follow on social media, facebook.com/daytradesmart, instagram.com/daytradesmart, and the number 1, youtube.com/theprovingground. Make sure you subscribe to our channel so you know when we're doing live events and you know when we've uploaded something. And then, of course, if you have questions beyond that, you can always email us at info@daytradesmart.com. All right, really quickly, guys, I want to let you guys know about our Trader Lite program, which we are running a killer promotion on right now. It is absolutely free, so you pay nothing. There's no credit card required, which is awesome. And you're going to get software set up, on-demand training videos, tons of videos, guys. You're going to be able to watch those videos and further your day trading education. Weekly continued education webinars. So you're going to have access to our webinars and our daily trading webinars, where our coaches will go on and host a trading webinar, take trades. You can follow those trades because you would be considered one of our members. We would be able to trade with you. So definitely that by itself is awesome. Trader Chat for mobile and desktop, you'll be able to connect with other traders, be able to ask questions, see what other people are asking, get feedback, things like that. Of course, the real-time alerts, all the alerts that we send out, you'll have access to those. You're going to have access to our indicators, which I don't think is listed on here, but you're going to have access to our proprietary software, which we'll actually be looking at today while we're looking at the futures market. And so you'll have access to those as well. And one-on-one coaching. Guys, you're getting 2 sessions with a professional day trader, okay? 2 sessions with a professional day trader to help you step up your game. That by itself is invaluable, guys. Go out and check to see what it would cost to get one-on-one coaching, just 1 session with a professional day trader. And tell me, it's in the thousands, guys. It's in the thousands. And you're getting 2. Because we know when people check us out, they like us, they want to move forward with us. We want for people to be successful. And in light of COVID and things like that, we wanted to be able to offer our Trader Lite program to give people the ability to try us out, but also to give us an idea if you're the right fit for us, right? We want to be able to see if you're a good student, if you show up to appointments, if you do the homework, if you're teachable, right? So those one-on-one sessions, you're left with homework. You got to go finish that homework. Then we follow up that homework to see, where the progress is, see if you're a good fit for us. And if you are, then we invite you to come into our other programs where you trade our corporate funds. You keep 80% of the profit, all that good stuff. All right, guys. Also on the Lite, I do want to say we don't want our traders that are on the Trader Lite trading with real money until you upgrade to the next level, because you're not ready, right? So and again, we do things very differently, which is why we have a better success rate in the market, in the industries, than most others, right? Over 95% of others, and that's not an exaggeration. So we don't want you to trade with real money while you're just testing it out, because you don't know how to use it yet. You may not know how to backtest. You may not understand money management, so on and so forth. And so, we don't want you to trade with real money on the Trader Lite program. We just want it to be something that you can do to see if it's a good fit, if you can do it, if it's valuable, if it meets a personal need. So reach out to us. You can email us. You can go to our site. Actually, you can go to tradingjobsnow.com/KTG and just sign up. And it is in the description of this video. That link is in the description. tradingjobsnow.com/Kilo Tango Georgia KTG. Make sure you don't forget that KTG part at the end. And you'll be able to fill out a quick form. It does not ask you for credit card information. It's like first name, last name, email, phone number, and I think that's it. And then you're set. Our people will receive that information, and we'll schedule an onboarding where we do the software setup. We'll schedule your first one-on-one session. We'll plug you into on-demand videos. We'll, the whole 9. So definitely check us out. Reach out. if you're not certain as to where to go, you can always just go to daytradesmart.com, or of course email us info@daytradesmart.com. And all that information, of course, is in the description of this video as well. Okay, so we're going to talk about trading futures today. Okay, we're going to be looking at trading the S&P 500 minis, the ESMinis. All right, because I know we've talked a lot about Forex, and a number of you people have emailed and have asked if we could cover even briefly futures market. So I'm going to take this opportunity to go ahead and do that. So let's get started. So things to know: if you're just getting started with futures, make sure to educate yourself on the risk and functionality of trading these markets and demo first, right? So make sure that you know how to do it, you know how to get into the market, you know how to set a stop loss and take profit, you understand how it moves, what the leverage is. You got to know all of those things, otherwise you can get in some serious trouble, okay? Futures trades are done with contracts. So we were looking at lot sizes or volume, right? Now we're looking at contracts. You cannot incrementalize contracts. They are only available in the whole increments. For example, you cannot trade 1.5 contracts, not in the ESMini. You can only trade in increments of 1. For example, 1 contract, 2 contracts, etc. $25,000 minimum per contract leveraged is what is recommended to start trading futures. Okay, so $25,000 is what the recommended number is to use 1 contract, which means if you want to use 2 contracts, then you have to have $50,000. 3 contracts, $75,000, so on and so forth. And I'll show you that, guys, those numbers here in a moment. ESMini can be traded with as little as 1 tick or a quarter point, and we'll talk about what that means here in a moment. Futures markets are not 24/5. It's 8 a.m. to 5 p.m. Eastern time for retail traders. So the reason why I make this assertion here, retail traders, is because there are traders that are enterprise, small. They're like medium, investors in the market, or large institutions that can get in the market before the market opens and be in the market after it closes for everyone else. It doesn't seem fair, and it's not, but it's the way it is. Okay, so futures markets are not 24/5. They're 8 a.m. to 5 p.m. for retail traders, Eastern time. Carrying trades from one day to the next will incur overnight fees that can carry up to 10 times or more leverage requirements. Okay, so with Forex, if you carry a trade from one day to the next, which is 5 o'clock Eastern, and because it's a 24/5 market, then it goes to the next day at 5 o'clock Eastern, right? So 4:59, the day ends, 5 o'clock, the new day starts. Carrying a trade over, depending on which direction you're going and what currency pair, it will either pay you, okay, I don't know if you guys know this, but it will either pay you a swap fee or it will charge you a swap fee. And each currency pair is different. Now, when you're carrying trades from one day to the next with futures, you get charged. And in addition to that, you have to have additional leverage. So normally the leverage, well, it depends on what broker, but I'll tell you the leverage that very competitive brokers will use. That's why we're not talking about leverage, because we don't make recommendations for brokers, and everyone is going to have a different result. But the leverage is going to be per contract. You'd have to have $500 in your account, which if you look at $25,000 minimum, you're wondering, well, why do I have to have so much in there if I only need $500 to cover 1 contract? Well, because the leverage can go up by 10 times or more, right? So we've seen it go 20, 30, 50, 100 times. So if you had $500 in there for 1 contract, you could be expected to have much, much more than that, right? But let's just say 10 times more than that. That would be 5,000, right? 20 times would be 10,000. So 25,000 is, 25,000 is like, 45 times additional leverage to carry it overnight, which is not unheard of, by the way. Which means if you don't have the leverage in there, then you can get removed from that trade and lose, right? Because you don't have the leverage requirements to cover it. So you don't want to get into situations like that. It can be really dangerous, especially because, again, there are traders, there are institutions, there are big, banks and things like that, and medium-sized enterprise-type institutions that can trade outside of retail trader trading times, which means the market will still move, right? But you're not able to do anything about it. You're not able to get in or out of positions. You're stuck until the next day, which is, 8 a.m. Eastern time. So something to definitely keep in mind. The futures market is one of the most regulated markets in the world. This means there are more rules that work against the retail trader than in other markets, like we were talking about, right? Other traders can get in and you can't, right? There's stuff like that regulates you, right? And if you guys have watched our other sessions in the sweep, we talk about regulation, right? And how most of the time that means that the trader is regulated, not the broker, which is why a lot of these banks and stuff don't like cryptocurrencies, by the way, guys, because although they are regulated, of course, right, and they're starting to get more and more regulated, the whole concept of the cryptocurrency is decentralization. So there's no bank or centralized institution that holds sway over that. It's decentralized, okay? So we like those things. So don't let people scare you by saying, oh, that's not regulated. I mean, look into it, right? Don't just take that word not regulated or that phrase not regulated and make it instill some type of fear in you. Most of the time they can't explain what is not regulated or what is regulated about it. They just like throwing that term around to kind of steer you in directions, right, where they want you to go, right? Okay. And each contract is worth $12.50. So actually I'm going to cover this on the next slide over here. So contracts, ticks, and points. A tick is a quarter of a point. So let's say the price is 41.30.50. The number after the decimal increases and decreases by 0.25. So this 50 right here, right? It increases and decreases by increments of 0.25. So the 0.25 increment is called a tick. If the market moves up by one tick, the new price would be 41.30.75. Okay, so 41.30.50 plus 0.25, 41.30.75. A point is 4 ticks. Okay, so if the market moved up from 41.30.50 by 1 point, the new price would be 41.31.50. One contract equals $12.50 per tick. So one contract equals $12.50 win or loss per increment of movement, 0.25 increment. So in this example, if the market moved up by one tick to 41.30.75 and you were in with one contract and it hit that number and you took profit, you would make $12.50. Okay? If I were taking a 2-tick profit with one contract, that would equal $25 take profit, right? So $12.50, that's one contract, times 2 ticks equals $25, okay? If I were taking a 2-tick profit with 5 contracts, that would equal $125. So same amount of movement, but vastly more, $100 more, right? And this, we've talked about these concepts too. More movement doesn't necessarily equal more dollars, right? Because you can see the same amount of movement, 2 ticks, 2 ticks. This one's $125, this one's $25, right? So this is $12.50, right, which is one contract times 5, because we're doing 5 contracts, equals $62.50. So 5 contracts for one tick equals $62.50. And we're doing 2 ticks. So $62.50 times 2 ticks is $125. Okay? All right. So let's look at this. Okay. So we have here is ESM21, right? So this is ESMinis in the June session. And what we're going to be looking for are some quick setups. And so you can kind of see how this works. So we're going to take a few on this 5-minute chart, and these are some from this morning, right? Some setups that were executed this morning, and we're just going to use. Now you'll notice that we're using 5 contracts, so each increment of movement is worth 62.50. Okay. My goodness, I'm not able to write today. 62.50, right? Man, my mouse is just acting up. At least that's the excuse I'm going to use. Okay. So right here, we're going to be taking, when we look at these 5-minute setups, we're going to be taking, let's see what my target is. So we're going to be taking a point, which is 4 ticks, right? So we want this to go to 41.31 if we were taking profit, or 41.31.50 to 41.32.50 if we were entering the trade right there, right? And then on our 1-minute chart, we're going to be taking 2 ticks with a 4-tick stop loss. So this is a 2-to-1 ratio on the 1-minute, and this is a 1-to-1 ratio on the 5-minute. Okay, so I just want you guys to understand that. We're taking 4 ticks profit with a 4-tick stop loss, and here we're taking a 2-tick profit with a 4-tick stop loss. Okay, so I'm going to replay this chart right here. Let's go there. All right, so what we're going to be looking for is just a number of different setups. First on the 5-minute. Okay, and we had a couple that showed up, and so I'll kind of explain to you what they are when we see them. So this one right here, we can see is shaping up to be what we call a flat top. So we've got thick orange, that's flat, value of zeros, major, minor are above the thick blue line. This is what we call an illogical setup, because when we see this, we want to look for movement back in the other direction, which seems illogical, right? Because these lines are pointed up, right? And we want it to stay that way for the duration of this 5-minute candle. So we still have 4 minutes left on this candle. So at the end of that 4 minutes, if that line is flat, this value is zeros, and these lines are still above this blue line, then we're going to take a sell trade or a short trade. And we're going to be looking for 4 ticks of profit with a 4-tick stop loss. Okay? So fortunately, because this is not live and it's replay, I'm going to just fast forward. And let's get down to the last couple seconds. 2 minutes. 1 minute. 30 seconds, 20 seconds. Let's stop right there. Okay, we have about 20 seconds, and we can see that the line is flat, zeros, all 4 lines are above, so we're going to be looking for a short or a sell trade. So I'm going to hover over this sell button, 8, 7, 6, 5, 4, 3, 2, 1, go. Okay, new candle came out. That red line in the middle is our entry. That green line on top is our stop loss, and that green line on bottom is our take profit. So we are taking profit as it moves down, right? This is the ESMini S&P 500, and we can make profit if it goes down, which is great news, right? Because if something is happening, if we're in a bubble or the markets aren't doing very well, we're not worried about it because it's not stock. We're just speculating that this is going to go down or short, right? So as soon as it crosses that line right there, we'll be able to take profit. There we go. We took profit there, and we're out of that trade. And you can see we made $250 because we're using 5 contracts, right? So 5 contracts is $62.50, right? So let me show you. Let's do the math real quick. So 5 contracts, or 1 contract times $12.50, right, is $12.50 times 5, is 62.50, and we're moving 4 ticks times 4, 250, and there's our profit, 250. Okay, so that's what we're going to be making for each of these trades because we're taking a point. We want this to move down by a point, 4 ticks. Okay, so it moved from here, 41.3275 to 41.3125. Right, but sometimes it's got to move more just to cover kind of the spread and first in, first out, and so on. And sometimes you get lucky and it's pretty close. Okay, so let's wait for our next setup. All right. So I think what we're waiting for on this one, is going to be a hiccup pattern. Hiccup is when green and red, and I think you guys were, if you guys had attended one of the sweeps that we've done before, we talked about the hiccup pattern. Green down, red up, not crossed or touching, minors crossed and touching the threshold or entering, green pressure on top, and a red candle. That all gives us a hiccup pattern, and if that stays that way, then we're going to take a buy trade, a long trade. Okay, so we'd be pressing the buy button. So we're going to wait 2 minutes and 28 seconds to see if it remains that way. So again, the 4 elements is majors are hiccuped above the blue or below the red, but in this case above the thick orange or above the thick blue line right here. Green down, red up, so they're disagreeing, right? And they're not crossed or touching it at the end right there. Minors are crossed and trying to short, they're trying to sell, right? Green pressure is on top, and there's a red candle. Okay, all 4 of those parameters make up the hiccup pattern, and in 1 minute and 55, if that remains that way, then we're going to go ahead and take another long trade. Okay, so let's speed this up a little bit. So let's see, 1 minute and 10, 5, 4, 3, 2. So we got about 20 seconds, 15 seconds. We got 15 seconds. It doesn't look the way it's supposed to right now. Let's see if it, I know it forms out because this is one of the ones that we took. So let's get ready to press the buy button. 2, 1, there it is right there. Boom. Okay, we're in that trade. You can see, let me go back real quick. You can see right there, green down, red up, minors crossed, entering the channel, green pressure on top, and there was a red candle. So we got into that trade. And come on, almost out. Let's wait for that. Now there's a follow-up to the hiccup. You've got majors pointed up and minors pointed up. This is vastly overbought and needs to digress back down. So again, it's illogical, right? And again, if you guys watch that series on hiccup pattern and the follow-up trades, then you would know about this. So we want this line to point up and we want this line to point up after the fake out. So majors faked out the minors. Minors are trying to sell. Now they've got to go up. Right now they got stopped out, or they're getting stopped out. And if both of them point up, then on the next candle we would take a short or a sell trade. So let's fast forward this. So it's 3 minutes, 2 minutes and 30 seconds. There we go. Okay, that one finished. That's good. We got about 1 minute and 40. 5, 4, 3, 2. Stop right there. So we can see both of these lines are pointed up right after the fake out. 12 seconds. If they stay that way, we'll press this sell button. 7, 6, 5, 4, 3, 2, 1, go. All right. So now we're in a sell trade, right? You see our profit for the first 2 trades, $500. So now we're in a sell trade. So we want for this to go down to this green line down here before it goes up to that green line up there. Good. All right, that's out. So good, we got out of that one. Looks like it kind of jacked us a little bit, or maybe gave us a little bit extra. That rarely happens. Okay, so now we've got our final trade, which is both of these pointed down after that fake out, and then we sell. So right here we bought, right here we sold, and then right here we're going to sell again. Okay, and that's the sequence to the hiccup pattern. You can look at those videos that we did before. For those of you guys that are already light members or in our already part of our membership, you can go and look at flashcards or any of the videos that we've done over the years on the hiccup pattern and look at that. So right here, we want for both these lines to now point down together, and this is more of a directional type trade, right? Both of them pointed down, we would take a sell. Okay, so let's fast forward this. 3 minutes, 2 minutes. 5, 4, 3, 2. All right, stop right there. Good, they're both pointed down. So right here we would take a sell in, 10 seconds. 9, 8, 7, 6, 5, 4, 3, 2, 1, go. Right there. All right. So now we're in this sell. Now we want it to go down to this bottom line before it goes up to that top green line, right? So you see the market didn't really move it didn't have to move very much for us to be able to utilize and take profit in those trades, nor were we waiting for some headache of, lines that intersect and all this technical analysis and all this craziness. We just have our indicators, and our indicators give us direction, right? And we back test that to determine what our stop loss and take profit would be at the specific time on the specific markets, so that we can establish that we have something that's going to work mathematically, scientifically, and profitably, most important, right? And it doesn't matter if it's in a whole bunch of, points or ticks, or if it's just in a small amount. And here you can see we had just a really small amount of movement, 1 point in either direction, and we're able to make something very significant, right? So still waiting for this one to fill. It's got about 3 minutes and 30 seconds left on this candle. It got there, you can see, but it's got to go through the line. You can see on the 1 minute chart right here, it got there, but it's got to go through that line. It can't just touch it. There's first in, first out rules and stuff like that. So even if it goes through it, if there were other traders that are filling their trades before you, then you got to wait until you're up, and then it'll fill your trade. So still waiting for that. Two minutes and 53 seconds left on this candle. Kind of doing some back and forth here. Come on. We can see right here. It's harder to tell in the 5 minute because it's so close to it, but right here on the 1 minute we can tell, right, how much more we have to go. Now, obviously, if it goes to the next 5 minute candle, we still just have to wait until it takes profit. So it's not like the trade expires after the 5 minutes is up, right? It just stays in play until you flatten it, so you can actually just close it at whatever the loss or profit is, or you can, or it'll hit one of those parameters, the stop loss or the take profit. Still waiting for that. See, we're just above our line, just by a little bit. Okay, now we're starting to move back down in the direction we want to go. And it's all sixes here, right? Because from that middle line, it's the same distance up and down. So we want it to go down first before, you know, it does anything else. But after it takes us out profitable, we're good. The money is safe in our brokerage account. You know, even if the market takes off, oh, there you go. All right, it's out now. Even if the market takes off in another direction, we're still safe. The trade is still safe, or rather, our account is still safe because we've taken profit. We're no longer at risk in the market. Okay, so let's go to our let's look at our 1 minute because we have some trades we can do on the 1 minute as well that we took. Now, these are much more simple. All we're going to be looking for is for these lines right here to be below this and then simultaneously cross up together. All four lines being below, and then on the same candle, all four lines cross and point up. And then we'll take a buy. And then when they're above here, then all four lines cross and point down, and we'll take a sell. Okay? So we'll see what that looks like here in a moment. And I'll explain it to you as it pops up. So right now we wouldn't even be looking for a trade because these lines, now they're below, right? Now that they're below, if they cross and point up together, that's what we'd be looking to execute the trade, right? Like that. They crossed and pointed up together. Now in 52 seconds, we're going to be looking to take a buy if it stays that way. We can see they're below right here, and now they're crossed and pointed up together. So in 40 seconds, we'll take a buy if it stays that way, right? Well, I know it stays that way. So in 30 seconds, $25 seconds. 15 seconds. 10, 9, 8, 7, 6, 5, 4, 3, 2, 1, go. All right. So now we're in that trade. You can see that if I go back right here, well, it might take profit really quickly. Let's wait for that. We can see if we look at this right here, we had, oh, there it goes, took profit. We had all four of these lines below the red, and then they simultaneously crossed and pointed up, all four of them. So then at the end of that candle, we entered a buy, and then we got out right there. Now, again, we're only going for half a point or 2 ticks on this 1 minute chart, right? So you can see that where on the other trade, we were getting, you know, $250 per trade. On this one, we're doing $125 per trade, right? So it's half of that amount because we're only going for 2 ticks. Now, we're still risking $250 per trade, but we're taking profit of 125. And the only reason that works is because the win percentage is higher than 70%. Otherwise, it wouldn't work. It wouldn't be mathematically sound, right? So 70% or greater with a 2-to-1 is profitable. Okay, so now that we're above the blue line, we just want to see all four of these lines cross and point down together. Okay, they have to cross at the same time on the same candle. So right now we can see the minors are crossing, and let's say they stay that way. And the majors don't cross down. And then on the next candle, minors are already crossed down, but then majors on the next candle cross down, that would not count. We want them to both cross down at the same time on the same candle and stay that way for that candle, right? I mean, not necessarily, just to clarify, not necessarily at the same time, but on the same candle, right? Because minors could be crossed right now and then majors cross as long as it happens in the same candle. So we can see minors are crossed there. So even if majors cross down right here, we would not take that because minors are already crossed on the previous candle. We want them to both cross and point down simultaneously. So that means if we are going to take a trade up here, then we need minors to cross back up and then majors still be up, and then both of them cross simultaneously down. Okay, so we know that right here we're not going to have a trade set up, right? Even if this stays this way, because minors had already crossed on the previous candle. Right here, look, they're already crossed. And now majors are starting to cross. But minors had already crossed, so we're not going to do anything there. Okay, let's wait for that. So nothing, we're not expecting anything there. Okay, good. So minors are now crossing back up, which is good because then they'll reset. And then hopefully on the next candle, after this one, we can get them both to cross down together, right? And there's that fake out again, right? Majors faked them out. Minors thought we were going to start going south and instead pulled it back up. And so kind of the same thing is happening right here, right? They're both pointed up. Now we're not going to take the sell like we did on the 5 minute, but you can see if they both pointed up, we could make a case for being able to sell if we had back tested that, right? Six, 5, 4, 3, 2. So nothing there. Not here either, right? Because if we go back, we can see majors were kind of crossed already, crossed down a little bit, minors are crossed up, and they're not necessarily overbought yet. So even if these both cross down like this, we're not going to take that, right? So let's fast forward a little bit. Okay. So now it actually looks like we're heading back to the oversold, which means if they get down here and then they both cross and point up together, then we can have another buy. Another long trade. Wait for them to settle. Now it's nice and easy when you can fast forward, right? I mean, the trades were already done. We're just going back and replaying them, which is nice and easy and it's calm. But, you know, in a demo account especially, you want to put yourself in a situation where the emotion is real, right? So trade it live or, you know, in the live market, but in a demo account. And when you see, you know, your setup happening, you'll feel that anxiety. You'll feel it, you know, and you want to. For one, you'll get used to it after a while, right? And for two, you know, you'll know how to deviate to your plan in those times of emotion. Okay, so 15 seconds. This is not giving us anything. Minors are already crossed, so even if majors cross on the next candle, we won't take that trade. So majors are not crossed, and again, they kind of faked out minors, right? We can see right there, majors were kind of not hiccup, but they were close. Minors were thinking it was going to go to the buy side. Majors pulled it down. Minors are now correcting. And again, right after that fake out type scenario, when they both point down like that, we're not going to do it because we haven't back tested it. But both of them pointing down like that is a lot of times a good reason to take a long trade, right? Problem is that with a 1 minute, there's not really another chart that we can use to position a 1 minute. And a lot of times, even though they're both pointed down like that, you could still get movement down on the next candle before it goes up. So that's kind of why, we're not in favor of taking these, but they do work out pretty well, that often they'll go long, right, with no positioning. So they're still viable to back test. So right here, yeah, and right there, let's see. Let's see how far it goes down. That only went about a quarter point. Okay, so we want neither of them were crossed on the previous, and now they're starting to cross. So if they stay crossed like that, where they're oversold right here, you can see they're below the thick red line, and now they're crossed and pointed up together on the same candle, right? If they stay that way, then we'll go ahead and take a long or a buy trade in about 25 seconds. 20 seconds. So we can see that fake out happens pretty often, but our indicators are able to pick that up and we're able to capitalize on it. 7 seconds, everything looks good. 6, 5, 4, 3, 2, 1, go. Right there, good. Oh, that was nice. We like it when it fills fast. All right. So I want to go back really quickly and review that because there was a couple times that it occurred, right? So right here, we kind of had that scenario where miners were thinking it's time to sell. Majors were saying not quite. Came up, and even at one point within this candle during this wick, all 4 of these lines were pointed up, right? They didn't stay that way, but all 4 of the lines were pointed up. And then that would constitute, reason to short, right? And then there was some short. And then same thing happened back here where miners kind of crossed up. Now, majors weren't hiccuped. Later, when our traders learn to read the indicators more fluidly, you're not necessarily waiting for a pattern or the exact parameters. You can be a lot more fluid with it. But early on, you want to make sure that your parameters are very clear, right? We talked about that, in one of our other sessions. Make sure that this, yes, this is my setup. No, this is not my setup. Or maybe this is my setup, and maybe means no, right? If it's a maybe, it's a no. If it's a no, it's a no. The only thing that's a yes is a yes. Yes, this is absolutely my setup. So if we were using this, that would be a maybe to a no, which means it would be a no. But later when you learn to read the indicators, you can read them more fluidly. And so right here, as they started to point down together, after that fake out, miners had to recorrect and start pointing down. Right? Maybe got stopped out because they were trying to buy. And then that gives us reason to go long. Now, initially, it went short, but only from the entry here would have been about 0.25 pips, right? If we'd have got in early, it would have been more like half because you can see it gapped from there to there. So the start of this candle to there is about 0.25. And then it went up. 2.25 points, which is really significant. And then it continued up for even more. And right here is where we took our trade, and right there is where we took our profit on that trade. Here's another one. We didn't take this one. It's kind of a hydra, which indicates long or buy. But you can see it's very consistent with that, those overbought, oversold parameters. But consistent is not enough. You need to know what the parameters are for consistency, what your stop loss and take profit should be, and if it's consistent to the point where it makes profit. So it happening often is not a scientific or mathematical finding, right? You have to know not just often, but what's the number, right? 75%, 80%, 90%, and when it does, what is your stop loss to take profit ratio, right? And is that going to make profit? So again, we used a 2-to-1 here on the 1 minute, which was 4 ticks or 1 point, 4 ticks, and 2 ticks profit, right? On the 5 minute, we used 4 ticks stop loss and 4 ticks profit, right? So this one, we'd need to win that trade at least 70% of the time or better, or it would not be profitable. This one, we could do 60%. Or better. Now, I'm not a fan of trading anything that's below 70%, and we know that this will perform better than 60%. So this is really good, right? Because it's going to have a high win percentage and a small risk to reward ratio. Right? If you guys aren't sure how that works, Again, watch some of the other videos. We talk about all this stuff. The only reason we're taking these, simulation trades and things like that is because the foundation has already been set, right? At this point, you have the resources, or you've already studied those resources, which are the videos on the YouTube site that show you start to finish, right? And we talked about ticks and points and pips, and we talked about risk to reward, risk percentage, probability. We've talked about all of those things, and mostly on the Forex market. And the reason for that is because, let me show you this real quick. So I broke it down like this. So if we look at needing one contract for every $25,000 we have in our account, now this is just reflecting 10 trades. So 10 trades, one contract is $200 in profit at 80% win. So 8 out of our 10 trades that we took won, and that gave us $200 in profit. Okay, and so that would obviously increase our balance, and so on and so forth. So if we looked at it just that way, right, we're not going to look at like loss and stuff like that. I just want to show you guys kind of how this breaks down. So if after 10 trades you made $200, then your account is $25,200, and it isn't until way down here that we get to 50,000, which is, double our account, right? And then we can increase to 2 contracts. That's 1,250 trades later. Okay? Now let's count this out. If we had, this was our trade day, right? Then we would have 1, 2, 3, 4, 5, 6 trades, right? So we would have taken 6 trades. So let's just say we took 5 trades a day, right? Because you're not always going to be able to get 6 trades. I mean, you probably can if you push it too much, but already we were 5, 10, 15, 20, 25, 30, 35, 40, 45 minutes in with these 6 trades, right? And it was just a good day. But let's just say 5 trades. Let's try to keep it conservative. So if we took 5 trades a day, right, and each month has 20 trade days, and each year has about 200 trade days. So let's say 200 trade days in a year, okay? So 1250 divided by 200. So that's about 62.5, right? So if we had 1,250 trades to do, and we took 10 trades, let's say 5 trades a day. Sorry, let's do that first. So 5 trades a day, okay? So that means every 2 days we'd have 10 trades. Okay, every 2 days we'd have 10 trades if we did 5 trades a day. Then right here, we would have 250 days, right, to do 1,250 trades. If there's 200 trade days in a year, I mean, there's probably more or less, but just about, then that's a year and 2.5, let's call it a year and 3 months, right? Because there are some Monday through Fridays that are holidays, and the ESMini market is closed, right? There's bank holidays, there's, other stuff where those markets are not going to be open. So, and then of course weekends, right? Because there's 365 days in a year. But there's I'd say roughly about 200 trade days in a year. So if we have 250 trade days at this point, then that would be in calendar time, that would be about a year and 2.5 months. So let's just say a year and 3 months. And then we can start using 2 contracts, okay? And then from there, obviously, our profits increase, even though we're trading with the same parameters, right? 80% win rate, 2 pip take profit, 2 pip, or 2 tick take profit, 2 tick stop loss, right? 2 tick stop loss, 2 tick take profit. It's a lot of T's in there. right here, 376 days total, right? We'd be able to increase to 3 lots. All right. So from here to there is about 63. So it'd be double that. So it'd be about 126 days. So again, 200 trade days. So that's almost, what is it, like 8 months or something, right? So 376 to get to three contracts. And by the way, doing this, you're not withdrawing from this account, right? Because to this point, your account has made you $25,000, and it's taken over a year to make $25,000 in that account. If you started with $25,000, right? Obviously, if you started with 50, then it's going to take you, 8 months or so to get to 75, and so on and so forth. Okay. All right. So if you withdraw from this account, then whatever your balance is, so if you withdrew that $25,000, then you got to start back over up here, $25,000, one contract. So let's say you did not withdraw, and now you're at $50,000, and then you grew that to $75,000. So now you're up by $50,000, right? Again, if you withdraw, right, then whatever you withdrew, so let's say you withdrew your initial $25,000. So you get your $25,000 back, right, which means now your account is at $50,000. And so then you go back to 2 contracts, right, so on and so forth and so on. Now, if you did not withdraw, I like the number 500,000. I think that when you build your account to 500,000, anything above that you should liquidate, maybe on a quarterly basis. So let's say you're at 500,000. Well, the next quarter, so next 3 months, whatever you earn in that, liquidate back down to 500,000, and then do it again, right? Or every month, or whatever, every week, right? Whatever it may be, but definitely diversify, right? Okay. So right here, you're at 100,000, and this is 410 trades. From here to here, another 410 trades, right? And then here, 520 days, or 310 trades from the last increase. 520 days overall, you're at 5 contracts and 125,000. So if we go all the way to 500,000, right here, it's 886 trade days. So that's 4.5 years about. 4.5 years, but you're at 500,000. This is one of the reasons why I'm not a big fan of individuals just getting started with day trading in futures. Now, if you're going to start with 100,000, yeah, absolutely, right? Because from 100,000, let's go to 100,000. From right here, right, you're starting off trading 4 contracts, right? If, of course, your risk to reward and risk, all that stuff lines up. But hypothetically, right, then from there, right, to 500,000 is, so 458. $886. So you're looking at about 428. So that's, 2 years and a month versus 4.5 years, right? If you're starting off with 100 grand, and of course you're starting off with 100 grand, and you know what you're doing, right? But in Forex, and you guys have watched this in some of our other sessions, in Forex you can incrementalize each one of these trades. So you win, and you can increase your lot size. Where this is a contract, you would increase your lot size. And we've got traders in the Forex market that are doubling their accounts every couple months. right? Just a few months and they're doubling their account. Where here, it's taking quite a bit, right? That's a year and a half or a year and 3 months to double their account. So that's, even if it took you 6 months or 6 months to double your account, that's still more than twice as fast than you can in the futures market. Because of all the regulation, because of the leverage requirements, because not being able to incrementalize your contract, so on and so forth, it does handicap you from making the most out of your trading time, out of your trading ability, right? Now, the other thing is that it's a 24/5 market, so you can trade it 24 hours a day, 5 days a week, right? Which is good for anyone's schedule. Where the futures market is definitely best in the mornings, right? It's best when it's moving in the mornings, and you can see the times that we were looking at these trades. Let's go back to these real quick, right? These were the morning sessions. So if I go back to that first one, right here, 12:55, right? And so those are going to be morning sessions, right? Going into the rest of the day. Based on what, the offset of these times. Oops. So is there a best time to trade? Well, it's the time that you're available to trade. But there are certain markets that will definitely hinder that, like the futures market, right? Because of the way, you got to be able to get in on that movement if you're looking at futures, right? Because later on in the day, it does tend to flatten out. Now, if that's the only time you're available, well, then you've got to backtest and see what works, right? But it's got to be at least a tick and of movement, and you got to account for first in, first out and slippage rules, which are more aggressive than you would experience in the Forex market, which can make it very difficult to get in and out of trades early on. Or not early on, sorry, later on in the afternoon and towards the end of the day, because the market's just not moving very much, right? It can be done, but it gets more difficult. Now, with Forex, obviously it's 24/5. So if you like the movement, you can find a currency pair that's going to be moving later on, right, in the evenings or whatever it may be. Right, so there's more flexibility there. In addition to that, all these setups that we're showing you today are all setups we've already showed you in Forex. So again, we like to start people off in Forex because what you learn there, you're going to be able to apply in other markets, right? We talked about flat top. We've talked about hiccup pattern and the follow through to hiccup pattern. Right? We've talked about the classic, which is on the 1 minute, or not the classic, but just the double cross, right, on the 1 minute. So, right, those are all from, so right there, right, and then right there. We've talked about all those, but we've looked at them on the futures market, or the Forex market. And now we're looking at them on the futures market, and they still apply. It's going to be different, right? The stop loss take profit is going to be different. The risk, all that stuff is going to be different because it's a different market. And we're using a 1 minute and 5 minute, where on the Forex market, we've used a 5 minute, a 60 minute, a 1 day, I don't know if we've looked at duck, I think we have. So we've looked at a 1 day chart, where in the futures market, we're going to stick to some of these smaller time frames, right? Or maybe even a tick chart, 1 minute or 5 minute. You can see the same patterns that you would already be familiar with are going to apply as well. Right, here's a Hydra. We haven't talked about Hydra. Maybe we'll talk about Hydra next time. And so it gives you the ability to practice in a market that is more conducive to people's time, right? Because we've got jobs normally when we first start trading. So you've got to do your 9 to 5. You got to, maybe you got family responsibilities or whatever it may be, right? And you can always find a time to practice, knowing that whatever you learn there, you're going to be able to apply in other markets. So hopefully this was helpful to you guys. Again, if you have any questions about this and specifically about futures markets, of course, reach out to us. And we're going to go and wrap up for the day. I appreciate you guys joining us. For those of you guys that are part of the mastermind, we'll see you guys on Tuesday morning for the mastermind session. And everyone else, we'll see you next Friday for the sweep. You guys have a good one and happy trading.